So is inflation really sticky, or is the report altered by unusually high reported rents? Joining us to debate and discuss, Aditya Bhave is head of U.S. economics at B of A Securities. Paul Christopher is head of global investment strategy at Wells Fargo Investment Institute. And CNBC senior economics reporter Steve Leisman is here with us as well. Steve, in the past 4.5 hours, have we learned anything about what's going on with owner's equivalent rent?
It just remains sticky, Kelly. We can't seem to get that series to match what we think is going on in the broader economy, which is a decline in rents and even home prices. It remains to be seen what happens as the Fed reduces rates and mortgage rates come down, whether or not that brings more buyers into the market and perhaps pushes it up. But this series should have gone down, I don't know, 12, even 18 months ago relative to what's happening with other series. So I think the Fed will tend to discount this and maybe just see it as a snapback from some lower numbers that we had previously.
Well, that's exactly why I wonder if the Fed were to discount it, Steve, wouldn't that actually maybe take the impetus off of today's report, pushing them towards doing 25 instead of 50, for instance?
I think the report overall does sort of, as you said, nail in the coffin for 50. I don't think this is a report that says we have a real deflation problem that the Fed has to catch up to. I think the Fed wants to do 25. I think it will do 25. And I don't think there's much in today's CPI or tomorrow's PPI that would suggest the Fed would do 50. I would also note that the market increased the probability of 25 basis point cut in September.
DL, bring you in here, and you are expecting, correct me if I'm wrong, 25s, maybe a series of them at the meetings to come. And how do you expect the Fed to talk about these rate cuts as well?
Right. So for now, we think the Fed is going to talk about the rate cuts as being somewhat gradual. I don't know they'll explicitly use that word because they don't want to pre-commit to a pace of cuts, especially when they know how quickly things can move around turning points. But at the same time, they do want to stress that the base case is for a soft landing, and a soft landing means that you cut relatively gradually to get back to neutral. So, they'll express some concerns around the labor market, as they should, but at the same time, they will express confidence that the economy is holding up. And so these are not rate cuts that are bringing you deep into accommodative territory. You're not yet saying, look, there's a recession, we need to accommodate the economy. What you're just saying is the time has come to get back to neutral, and we can do so fairly expeditiously, going 25 basis points per meeting.
So, Paul, we're looking at the Dow intraday, which was down more than 500 points, kind of in the aftermath of this report, and these 50% cut odds going, smaller. Now we're recovering. Why do you think that is?
Yeah, we've seen this happen so many times. I've lost count since 2022, the middle of 2022, expecting rate cuts, hoping for rate cuts, praying for them, and then they don't materialize quite as quickly or in the magnitude that the markets are expecting. I think that's what you've seen in the knee-jerk reaction to today's report. We want to stay kind of focused on the future. It's really an academic question, 25 or 50. We think they cut a full percentage point this year and more into next year. We see that soft landing. We agree with that scenario, and we think that now's the time to start positioning for that eventual economic pivot to stronger and more sustained growth. We think the economy gathers strength in the end of next year, and that's going to create more cyclical opportunities for investors.
Steve, do you think it's significant, the stock market reaction here? Because if we had, a 1,000-point sell-off, as market said, wait a minute, they might not go 50, that is information on some level that's what the consensus, the market opinion thinks is warranted. And the fact that we can, we're down almost 200 points right now, call it almost unch, that feels like it's the financial system giving permission for a smaller cut on the hopes that maybe we can have a soft landing.
Well, I think the way to think about the market here, and I'll defer to other experts on it, but my take has been that the market thinks it can have its cake and eat it too. It can have rate cuts and it can have relatively strong growth. Every time that growth story comes into question over the past several weeks, Kelly, it seems like the market sells off. And I think the market is right here in that sense that Fed rate cuts, if you do have real weakness, will not completely offset it. It'll be something of a salve, but it won't be enough to offset real economic weakness. And that would, of course, create the situation where the Fed would need to cut much more quickly and much more deeply.
Right.
But right now, the market baseline, I think, is a soft landing with rate cuts. If that soft landing turns into something harder, I think that's what concerns the market.